Okay, get this. Ready to dive into a company that makes a ton on something you probably don't think about much.
Yeah.
Metallic flexible flow solutions.
Okay.
Millions of meters.
Millions of meters of this stuff. All right, I'm intrigued.
Yeah, it's pretty wild.
Not exactly something you see on the supermarket shelves every day.
No, not exactly.
So what are we talking about here? What are these flow solutions?
Well, think of it this way. Controlling flow, but not just any flow. I'm talking solids, liquids, gases,
Oh, wow.
and in crazy environments like, scorching hot steel mills,
Yeah.
chemical plants, even oil pipelines.
Okay, so we're talking serious industrial stuff.
Oh, yeah, this stuff is built tough, that's for sure.
So what's the company we're looking at today?
Today, we're dissecting Aeroflex Industries.
Aeroflex Industries.
And we've got their fresh financials, their unaudited Q2 report for fiscal year 2025.
Okay, fresh off the press.
Fresh off the press, exactly. And we've also got management's take on it all and their investor presentation.
So we've got the numbers and the story behind the numbers.
Yeah, the whole shebang.
And what's the mission of this deep dive?
Figure out what it all means for you if you're eyeing this company as a potential investment.
All right, let's get into it.
So let's start with the big picture. Aeroflex is reporting a 13% year-on-year revenue growth for Q2, hitting a cool 94.99 crore rupees.
13%, not bad at all.
Not bad at all. But here's the kicker. They're still aiming for that ambitious 25% jump in EBITDA annually.
Hold on, EBITDA. Now,
Mm.
for those of us who don't speak fluent finance,
Yeah.
can you break that down for us?
Absolutely. So EBITDA stands for earnings before interest, taxes, depreciation, and amortization.
Okay,
It's basically a way to gauge a company's core profitability from its operations.
got it. So cutting through all the accounting jargon.
Exactly, getting to the heart of how much money they're really making.
So 25% jump in that core profit number, that's pretty significant.
Yeah, no wonder their managing director, Assad Daud, sounds so pumped.
What did he say?
He said they're delighted to exceed market expectations. That's confidence talking.
It definitely is, but let's break down those revenue sources a bit further. Where's all this money coming from?
Sure, so a big chunk, about 52%, comes from their bread and butter stainless steel flexible hoses.
Okay, the classic hose.
The classic
Yeah,
hose, right.
Okay.
And then another 39% flows in from assemblies and fittings.
So essentially customizing those hoses for specific tasks.
Exactly, making sure it fits just right.
Interesting. So it's not all just hoses. They're offering a whole suite of solutions.
Yeah, the whole package deal.
So they've got their home market, but what about globally? Are they reaching customers beyond their borders?
Oh, yeah. They've got a strong foothold domestically, with 83% of revenue generated there.
Okay, home base is strong.
Home base is strong, but get this, they're also reaching a whopping 89 countries with their exports.
89 countries. That's pretty impressive.
It is a pretty impressive global reach.
So they're not just sticking to the old school industrial players then.
No, they're branching out, dipping their toes into some really exciting sectors. Fire sprinklers, solar energy, robotics, even the electric vehicle and aerospace industries.
Wow. So they're really diversifying their portfolio.
That's right. Tapping into these new age markets, Aeroflex is positioning themselves for some serious future growth.
They're not just riding the coattails of existing industries. They're becoming part of the next wave of technology.
Exactly. They're future-proofing themselves.
And speaking of smart moves, they just acquired Hyde Air Engineering.
Yeah. What do you make of that?
Well, that's not just any acquisition. Hyde Air specializes in metal bellows and expansion joints, products that perfectly complement Aeroflex's existing lineup.
I see. So it's like they're building a one-stop shop.
It's a classic vertical integration play, meaning they're bringing more of the supply chain in-house.
Ah, so streamlining operations and potentially boosting those profit margins.
Exactly.
Plus, they just snagged a trial order from a railway coach factory for these new products.
That trial order is a great early indicator.
Yeah.
If it converts to a full-fledged contract, that's a significant new revenue stream for Aeroflex.
So they're hitting the ground running with this acquisition.
For sure. It shows they're not just acquiring companies, they're actively leveraging those acquisitions for growth.
All right. And to handle all this growth, they're doing some serious capacity expansion.
How serious are we talking?
They've already ramped it up to a mind-boggling 15 million meters of hose production.
15 million meters.
And they're adding another 1.5 million by December 2024.
So just to be clear, we're talking about a lot of hose here.
It's a lot of hose. I mean, to put it in perspective, if they laid all that hose end to end, you could wrap it around the earth multiple times.
That's a lot of hose.
That's a visual, right?
Yeah, no more questions about the
Okay,
climate.
okay. Now, Beyond the numbers, I was also impressed by their commitment to sustainability and social responsibility.
Oh, it's great to hear.
Yeah, green processes, recycling, electric vehicles at their facilities. They even have an occupational health center and a child care center for employees.
That's really impressive. It shows they're thinking about the long-term well-being of their employees and the planet.
Yeah, it's the kind of stuff that makes me feel good about a company, you know?
Absolutely. Nowadays, investors are paying more attention to a company's ESG, environmental, social, and governance factors.
Right, and Aeroflex clearly gets it.
They understand that sustainability isn't just about doing the right thing, it's also good business.
So we've covered a lot of ground here. What stands out to you so far?
Well, what really jumps out at me is that they're not just talking the talk.
Yeah.
They're walking the walk. They've got a clear vision for the future, and they're backing it up with strategic moves and solid financial performance.
They've certainly painted a compelling picture.
So far, so good.
Yeah.
But to get a really clear picture of their financial health,
Yeah.
we need to go beyond the profit and loss statement and look at their balance sheet.
Let's do it.
Luckily, Aeroflex has provided us with a consolidated balance sheet along with their income statement.
Excellent. We love transparency.
So we can dive right in.
Lead the way. Balance sheets can sometimes be a bit dry, but I'm always up for a good treasure hunt.
All right, let's see what gems we can unearth in Aeroflex's balance sheet.
All right, we're back and ready to dig into the nitty-gritty of Aeroflex's financials,
Time to put on our accounting hats.
or at least pretend we know what we're doing.
Exactly right.
All right, so let's start with their consolidated profit and loss statement.
Okay, the P&L.
The P&L, yeah. And the first thing that pops out is that consistent revenue growth we talked about. Remember that 13% year-on-year increase?
Yeah, pretty impressive.
Oh, they're not just hitting it overall. They're showing that same growth consistently across both quarters.
Oh, wow. So it's not a fluke.
No fluke here.
Consistent performance.
Consistent performance, yeah. And specifically in Q2, they pulled in 94.99 crore rupees from operations, up from 84.08 crore in the same quarter last year.
So steady and sustained growth, that's music to an investor's ears.
It is, but revenue is just one piece of the puzzle. What about their profitability? How are those margins looking?
That's where it gets really interesting. Their EBITDA margin for Q2 clocked in at a healthy 22.10%.
Okay.
A noticeable improvement from 21.35% the same time last year.
Now remember, EBITDA is that measure of core profitability we talked about earlier.
Right, cutting through the noise.
Cutting through the noise. So this basically means they're getting better at turning revenue into cold, hard cash.
And for investors, that's a beautiful thing.
It's like they're becoming a lean, mean profit-making machine.
Exactly. But can you break this down for me a little more? What does that actually mean in terms of rupees?
Sure thing. So their profit after tax, or PAT, also shows a positive trend. Their PEATNY margin for Q2 hit 14.26%, up from 13.71% a year ago, and that translates to an actual profit of 13.66 crore rupees for the quarter.
Okay.
A nearly 18% jump from the same period last year. They're making more money, and they're keeping more of it.
All right, so they're definitely making money and their profit margins are improving, but what about earnings per share, or EPS? That's another key metric investors watch closely.
You're right, EPS is a big one, and here too, Aeroflex is delivering.
What's the number?
Their basic EPS for Q2 stands at 1.06 rupees.
1.06, okay.
A direct reflection of that solid profit growth we've been discussing.
Right.
This means that for every share of Aeroflex stock you own, the company earned 1.06 rupees in profit during the quarter.
So painting a picture here, we see a company with rising revenue, expanding margins, and increasing earnings per share.
It's like a financial hat trick.
It's a strong performance, no doubt. But to really get a complete picture of their financial health,
Yeah.
we need to look beyond the profit and loss statement and peek at their balance sheet.
Oh, the balance sheet, all right.
Luckily, Aeroflex has provided us with a consolidated balance sheet along with their income statement.
Excellent. We love transparency.
So we can dive right in.
Lead the way. Balance sheets can sometimes be a bit dry, but I'm always up for a good treasure hunt.
All right, let's see what gems we can unearth in Aeroflex's balance sheet.
So what jumps out at you right away?
Well, one thing that immediately catches the eye is the significant growth in their asset base. Their total assets as of September 2024
Okay.
stand at a hefty 412.78 crore rupees.
All right.
A noticeable jump from the 374.97 crore they reported at the end of the previous fiscal year.
That's a pretty substantial increase in assets. What's fueling that growth? Are they going on a spending spree?
Not exactly a spree, but definitely strategic investments.
Strategic
A
investments.
large chunk of that growth comes from their investments in property, plant, and equipment, or PP&E.
PP&E, okay.
This makes perfect sense given their aggressive capacity expansion plan.
All right, they're getting ready for all that future demand.
Exactly. We're talking about an increase of nearly 10 crore rupees compared to the previous year,
Wow.
all going towards boosting their production capabilities.
So they're literally putting their money where their mouth is when it comes to growth.
Precisely. And it's
Wow.
not just about physical infrastructure.
Oh.
They're also putting resources into intangible assets, which have grown from 0.60 crore to 1.88 crore.
Intangible assets, what does that mean exactly?
Things like patents, trademarks, software, things you can't physically touch but still hold value.
Okay, I see.
This likely reflects their focus on research and development, which they highlighted as a key growth driver in their investor presentation.
Makes sense. If they're going to be at the forefront of these new age sectors, they need to be constantly innovating and developing new products.
Absolutely.
But hold on, we've been talking about all these assets.
Right.
What about the other side of the equation, and how are their liabilities shaping up?
On the liabilities front, things are relatively stable. Their total liabilities currently stand at 96.79 crore rupees,
Okay.
a slight increase from 81.83 crore at the end of the last fiscal year.
So their assets are growing at a faster pace than their liabilities. That's a good sign, right?
You're absolutely right.
It suggests they're not over-leveraging themselves to fuel this growth.
Exactly. Maintaining a healthy balance sheet is crucial for any company, especially one that's in a growth phase like Aeroflex.
Right, makes sense.
It gives them the financial flexibility to seize opportunities and weather any potential economic storms.
Well, I'm no financial guru, but based on what we've seen so far,
Yes.
Aeroflex seems to be in a pretty strong financial position.
They're ticking all the right boxes.
Yeah.
Growing revenue, expanding margins, and managing their balance sheet responsibly.
It's all looking good so far, but we know there's one more crucial piece to this financial puzzle.
The cash flow statements.
The cash flow statement. That's where we'll really see how they're generating and using their cash.
Which is crucial for assessing their long-term viability.
Absolutely. So let's follow the money trail.
Let's do it.
I'm ready to see what secrets this cash flow statement holds. Bring on the next layer of the deep dive. Okay, we're back. Ready for the final stretch of our deep dive into Aeroflex Industries.
The moment of truth.
We've seen their revenue growth, those impressive margins, that rock-solid balance sheet.
But as they say,
Yeah,
cash is king.
cash is king. So let's crack open this consolidated cash flow statement and see what it reveals.
All right, let's see how the cash is flowing.
So anything jump out at you right away?
Well, here's where things get really interesting. While Aeroflex has been showing off some serious profitability, their cash flow from operations for the first half of fiscal year 2025
Yeah.
tells a slightly different story.
Uh-oh, a plot twist.
Maybe a little. They actually reported a net cash outflow of 0.31 crore rupees
Okay.
compared to a healthy inflow of 13.33 crore rupees during the same period last year.
Wait, hold on. A company can be profitable but still have negative cash flow?
When you got it.
That sounds a bit counterintuitive.
It can seem that way, but think of it like this. Imagine you run a bakery and sell a ton of cakes, but haven't collected the payments yet. You've made the sales, but the cash isn't in your hand yet.
Okay, I'm starting to see the picture.
In Aeroflex's case, a big part of this negative cash flow is due to changes in their working capital.
Working capital, another one of those finance terms that makes my head spin.
Don't worry, it's actually pretty straightforward. Working capital is essentially the difference between a company's current assets and its current liabilities.
Okay.
It's a measure of a company's short-term financial health and its ability to meet its immediate obligations.
Got it.
In Aeroflex's case, they've seen a significant increase in their inventories,
Inventories, okay.
which ties back to those ambitious capacity expansion efforts we talked about. They're stocking up on raw materials and finished goods to be ready for that anticipated surge in demand.
Right, they're getting ahead of the game.
Exactly. They've also experienced an increase in trade receivables, meaning they're waiting a bit longer to collect payments from some of their customers.
So this negative cash flow isn't necessarily a red flag, more of a yellow light.
I think that's a fair assessment.
They're spending money now to make more money later, but they need to manage that carefully.
Exactly. It's not uncommon for companies in a growth phase to experience some short-term cash flow fluctuations as they invest in expansion and ramp up inventory. The key is to keep a close eye on these trends and make sure they don't become unsustainable.
Makes sense. So let's move on to their cash flow from investing activities. What can we glean from that section of the statement?
Well, unsurprisingly, we see a significant outflow of cash from investing activities, primarily driven by their capital expenditures on property, plant, and equipment.
Right, all that investment and expansion we talked about.
Exactly. They spent 19.44 crore rupees on these investments in the first half of fiscal year 2025, significantly more than the 8.87 crore they spent during the same period last year.
So they're walking the walk, putting their money where their growth strategy is, but those investments can be pricey. What about cash flow from financing activities? Are they taking on a mountain of debt to fund all this?
That's where it gets interesting. In the first half of the previous fiscal year, they actually raised a hefty sum of cash through financing activities, bringing in a whopping 90.51 crore rupees.
Wow. Okay.
This year, however, they've shifted gears. They actually have a net outflow of 2.76 crore rupees from financing activities.
Okay, so less reliance on outside funding this year. What does that tell us?
It suggests they're currently relying more on internally generated funds and operational cash flow to manage their growth, which is generally seen as a positive sign by investors.
Yeah, less debt is usually a good thing.
It means they're not overly dependent on debt, which can be risky, especially in uncertain economic times.
Sounds like they're playing it smart, striking a balance between investing for growth and maintaining a healthy financial position.
Right. It's a delicate dance. You need to fuel expansion, but you also need to be mindful of your financial leverage and make sure you're not taking on too much risk. So far, Aeroflex seems to be navigating this challenge effectively.
So we've taken a deep dive into Aeroflex's financial performance.
A lot of numbers.
A lot of numbers, but a pretty fascinating story, I'd say.
Definitely.
They've got a compelling story, but as with any investment, it's not without its nuances. They're achieving impressive growth, expanding strategically, and managing their finances responsibly. But that negative cash flow from operations does raise some questions about their short-term liquidity.
It's something to keep an eye on for sure.
It is. So as we wrap up this deep dive, what are your final thoughts on Aeroflex Industries?
Well, I think they're definitely a company to watch. They're operating in a niche market with strong growth potential, and they seem to be making all the right moves to capitalize on that opportunity. But as always, it's important for investors to do their own due diligence, dig into the details, and assess the risks and opportunities before making any decisions.
Absolutely. This deep dive is just a starting point, and we always encourage you to consult with qualified financial professionals before making any investment decisions.
Couldn't agree more.
Well, that's it for this deep dive into Aeroflex Industries. Thanks for joining us, and we'll catch you next time for another deep dive into the world of finance.
Until next time.